special guests with me. Let's call them in. We have Julie, we have Ayaz,
Hi Farah.
and we also have Hani.
I say hi Farah.
Hi
How are
Ayaz.
you?
Good, thank you. So today they will be discussing with me about the issues that arises from income taxes, impairment loss, and leases. So we have 3 cases. Julie will discuss case 1, myself will discuss case 2, Ayaz and Hani will discuss case 3. So today in this video we will talk about the issues that arises from income taxes, impairment loss, and also leases. So we have 3 cases. So Julie will discuss case 1, myself will discuss case 2, and Hani and Ayaz will discuss case 3. So we can start with Julie.
For case 1, I will discuss about the AASB in 112 income taxes and determine the effect of deferred tax asset and deferred tax liability. In short, is DTA and DTL. For AASB 112 income taxes, explain about the income taxes for current and future tax consequences, and in order to recognize the profit and loss. It also recognizes the DTA and the disclosure of income taxes. The DTA and DTL must be adjusted if there is a change in the corporate tax rate, as they may affect the accounting profit and tax expenses. If they are not recognized, which is confusing for user and investor to relate to the information and the financial report. Let's move to case 2.
Alright, so case 2 is on impairment of assets. I will be discussing on how positive accounting theory is useful to explain management's preferences or reluctance to recognize impairment loss with regards to management incentives, debt incentives, and political incentives. So let's start with the definition of impairment of assets and also positive accounting theory. So paragraph 6 of AASB 136, impairment of assets, define impairment loss as the amount of which the carrying amount of an asset exceeds the recoverable amount. Positive accounting theory is a theory that explains the accounting policy decisions made by an entity based on relationships or contracts between the entity, suppliers, managerial labor, and debt capital. So based on research, managers prefer to use the cost model accounting method in recognizing impairment loss rather than the revaluation method towards the report, due to the negative impact of the revaluation method towards the reported profits. So this can be explained by the 3 key hypotheses, that is the bonus plan hypothesis, the debt to equity hypothesis, and the political cost hypothesis. So let's start with the bonus plan hypothesis. So it is defined as the more the reported income, the higher the bonuses that the managers will receive. In order for managers to receive a higher bonus, they will have to find a way to increase their entity's profit, that is to use the cost model to recognize impairment loss because of its positive impact on bonuses, and by that to increase profits. Next will be the debt to equity hypothesis. Debt to equity hypothesis is defined as the higher the debt to equity ratio, the more likely the managers use accounting methods that increase income to decrease debt to equity ratio. So the reason behind this hypothesis is when the income increases, then the possibility to repay debts are higher, which will relax the constraint in debt covenants. However, if the debt to equity ratio is high, creditors and lenders tend to limit the debt covenants. Therefore, the accounting method that managers would prefer is the cost model, as it helps to increase profits and reduce restrictions from the lenders. And lastly, the political cost hypothesis states large firms compared to smaller firms are more likely to use accounting methods that reduces reported profits. So the political cost hypothesis is the opposite of the other 2 hypotheses due to its goal of wanting to reduce reported profits. This means that the managers will have to use the revaluation model in order to reduce the reported profits to avoid huge political costs such as income taxes. In conclusion, positive accounting theory is definitely useful to explain managers' preferences or reluctance to recognize impairment loss, whether using the cost model or the revaluation model. By using the cost model, the impairment loss of an asset will not give a negative impact to the reported profit. However, the revaluation model will. Therefore, if managers have to use the revaluation model, such as in the case of reducing political costs, they may be reluctant to recognize impairment loss. Alright, now we can go to case 3 from Ayaz and Hani.
That was great explanation. So in case 3, the BALTI Transport Ltd company who is operating the lease under ASB 17, IS 17, thus the look entered the company as the chief financial accountant and give them the proposal to adopt ASB 16, IFRS 16. But the company doesn't expected the proposal. So let's see why. So this question has two parts, part A and part B. Let's go through part A first, which I will explain it, and the part B will be explained by my friend Arlene. Yeah. The senior management of BALTI Transport Ltd is unwilling to adopt ASB 16 IFRS 16 under the reference of manager-lender agency relationship, because if the unsecured notes and liabilities of BALTI Transport Ltd will exceed 60% of the asset, this will increase the credit risk for the company. The bank and the other financial bodies compensate in the form of returns earned and interest from. Moreover, if the financial institution will consider the loan to result at a higher risk, this will lead to higher rate of interest. If the loan is measured for a lower risk, this will reduce the rate of interest. That's the reason BALTI Ltd does not want that the liabilities should increase more than 60% of the total asset, as this will help the company borrow money at a lower interest rate and will also reduce the credit risk for the lender. Moreover, if BALTI Ltd adopt ASB 16, then the ratio of their liabilities to total asset will reach to 66.7% respectively. Thus, in ASB 17, the ratio is 50%, which is a great move. Within the concentration of that inconvenient, moreover, the manager of BALTI Ltd unlikely to contend the adoption of ASB 16 IFRS 16 during the preparation of financial statement of the company. However, excessive dividends payments to owners, asset submission claims, dilation and underinvestment are some major crises which can increase the lender risk and manager-lender agency relationship. So now, Arlene will speak about part B.
Yeah. Well, in part 2, the management composition hypothesis, which is based on the agency theory, predicts that the managers whose remuneration is linked to the accounting profit are most likely to prefer accounting policies that increase the reported profit so as to increase their bonus. And although the adoption of ASB 16 and IFRS 16 is not accepted to have any material effect on the BALTI Transport Limited reported profit, agency theory can still be applied to explain the management's lack of support for the standard, and the manager's bonus is subject to have a performance hurdle. Managers are only eligible for the bonus if the BALTI Transport Limited are pre-tax return on the assets exceeds 15%. Based on a normal earning provided in the case, the pre-tax return on the assets would be 20% under ASB 16 and IAS 17. However, if ASB 16 and IFRS 16 is adopted, the total asset would increase and that reducing the pre-tax return on assets to 13.3%, which is below the performance hurdle of 15%. Accordingly, the management of BALTI Transport Limited are unlikely to support the early adoption of ASB 16 and IFRS 16 in the preparation of the company's financial statement, because it may result for being ineligible for a bonus. While not specifically required in the question, the case could be used to illustrate the potential cost of applying ASB 16 and IFRS 16, resulting for bringing off-balance sheet finance onto the statement of financial position. The standard length transition period may allow some entities opportunity to re-eliminate contracts to minimize the economic consequence of the standard. So that's it for case 3.
Alright, so to sum up, both current and deferred tax are being used to evaluate the financial position of the companies, which argues that companies predominantly have higher DTL and DTA. Positive accounting theory is used that is used so that the management can determine which accounting method is most rational in recognizing impairment loss. So lastly, the management compensation and debt contracting hypothesis based on agency theory demonstrate that an entity prefer to adopt the accounting policies that will increase their bonus rather than adopting the AASB 16 due to the negative impact. Thank you everyone, that's all from us today.
Thank you.
Enjoy our video.
Thank you everyone, that's all from us today. Thanks for coming to my show, Julie, Ayaz and Halin. See you guys next time.
What about the breakfast? We
No
need the
breakfast, no breakfast.
There's no breakfast?
No.
Oh.
Okay, thank you everyone. Thanks for watching.
Thank you.
Bye.